Hello there and welcome to Project Business Basics, designed to give you the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there is a place for everyone on our show. Today we're going to be talking about entering investments, and specifically 3 various methods of entering investments. If you find a stock or a fund that you want to put your money in and you want to invest in, well, there are several different ways of doing so, that it's best you know what these ways are and then evaluate and see what might be the best way for you. And each method has its own pros and cons with it, as we'll discuss. So the first method we're going to talk about is lump sum. This is going to be the easiest to understand. This one, you have a set amount of money that you want to invest. So let's say you want to put $200 into one stock that you really like. So you simply divide the $200 by the stock's current price and then you buy that number of shares and that's it. You've participated in lump sum investing. It involves one transaction occurring on one date. You put the entire money into the investment in that one transaction. Now, with dollar cost averaging, you have the set amount of money that you want to put in. So let's use the same number from our example, $200 that I want to put in stock XYZ. Now with lump sum investing, we used one transaction occurring at one time. But with dollar cost averaging, we're going to divide up this amount of money that we want to invest, say $200, into equal amounts, and we're going to invest these amounts during regular time intervals. So let's consider what this might look like. Let's say I want to invest $200 into stock XYZ. And stock XYZ, let's say it's January, and stock XYZ right now on January 1st is priced at $10. And it's January right now, so by the time April comes around, I want to have all my $200 invested into the stock. So that's 4 months, January through April. So 200 divided by 4 is $50. So that means then that I have to invest $50 or a quarter of 200 into stock XYZ in January. So stock XYZ right now is $10 and I'm investing $50. So $50 divided by 10 is 5. So I'm going to buy 5 shares of XYZ on January 1st at $10. Now in February, I'm also going to invest another $50. But stock XYZ's price has fallen down to $9. So I still do the same process though. $50 divided by $9 is about 5.56. So I'm going to purchase 5.56 shares of XYZ in February. Now in March, I'm still going to invest $50, but XYZ's price has gone up to $11. So $50 divided by 11 is 4.54. So I'm going to buy 4.54 shares of XYZ in March. Now, XYZ, let's say, had a really great month of March. So by April 1st, XYZ's stock price is up to $20. This is obviously very volatile, but I'm just using this for demonstration purposes. So $50 I'm investing in April. $50 divided by 20 is 2.5. So I'm going to buy 2.5 shares in April. Now April 1st has come around, so my total investment during those 4 months was $200, just like how I had planned it. Now the number of shares that I own of XYZ is based on adding up the number of shares that I bought each month. So in January I bought 5 shares, February 5.56 shares, March 4.54 shares, and April 2.5 shares. So when I add all of those together, I find I now own 17.6 shares of XYZ. Now we have to find out though, what is my purchase price of these shares? And the answer to this is calculated using a weighted average. And I figure out that my average purchase price of XYZ during this time was $11.36. So dollar cost averaging is really good for volatility then. But the downside for it is generally the market tends to go up over time. And if you're going to continually use dollar cost averaging over periods of years, then you're going to keep raising your purchase price each time that you invest money into it, assuming that your stock goes up. So it's really banking on the chance that your stock does better than the amount that you end up losing each time that your purchase price goes up. because our purchase price from this example of $11.36 is more than our initial purchase price of $10. So you're really hoping that the sheer volume, the amount that you make based on the number of shares that you own, is enough to offset the average purchase price increase. Now then, let's look at value averaging. Now this one is a little more difficult to understand, but it's slightly similar to dollar cost averaging. Now same situation. January through April, I want to invest $200 by April 1st. And I'm going to divide up that $200 by 4 because it's 4 months, so $50. Now instead though of investing $50 each month, the $50 to me represents a goal. So in January, that means I have a goal of having a total of $50 in value of stock XYZ. Currently, I don't own any shares of XYZ, so my present value is 0. So for this one, I'm just going to take my $50 divided by the stock price of 10, and I'm going to buy 5 shares. Now in February though, I still want to add another $50. So my goal is 50 plus 50 or 100. Now if you remember though, in February, XYZ's stock price fell to $9. So what's the present value of my investment from January? My present value of my January investment is $45 because I purchased 5 shares in January, but now the stock price is $9. 9 times 5 is 45. So that's the present value. So in order to get to $100 then in February, I need to invest $55 in order to get to that 100. So I'm going to take 55 and divide by $9. And when I do that, I get 6.11. So I'm going to buy 6.11 shares of XYZ at $9 on February 1st. Now in March, I'm going to want another $50 in the investment. So my goal for March is $150. Now the stock price of XYZ went up to $11 by March 1st. So using what we did in February, let's go through the process again. We own a total of 11.11 shares. That number comes from buying 5 shares in January and 6.11 shares in February. So 11.11 shares, and the stock price right now is $11. So 11.11 times 11 is 122.22. So the present value of my investment is $122.22. Now remember, my goal for March is to have $150 as my total investment in XYZ so far. So I need to find the difference then between $150 and 122.22. And that difference then is 27.78. So I'm going to invest $27.78 more into stock XYZ. Now currently it's $11. So 27.78 divided by 11 is 2.53. So I'm going to buy 2.53 more shares of XYZ in March. Now April, if you remember by April 1st, XYZ had gone up to $20. So the current value of my investment is 5 plus 6.11 plus 2.53, which is 13.63 shares. And 13.63 times the stock's current value, $20, means my investment is now worth $272.73. Now by March, I'd invested $150 into XYZ. So my goal for April then is to invest $50 more. So I need to have a total of at least $200 of value in XYZ. Well, the value of my investment is already way above $200. It's at $272. So for April, I'm just not going to buy anything. I'm just going to let the investment sit there. And then if I want to continue the same process, and if I wanted to reach the goal of $250 of total value by May 1st, I would then evaluate where the stock's price is at that point in time, and then see whether or not I needed to buy any more shares in order to meet my value goal for that time period. So with value cost averaging, in this scenario, our total investment for this example was $200. Our total number of shares we own at the end of the time period is 13.63 shares. And the average purchase price using weighted average calculations was $9.74 approximately. So in this example, we see that a pro for value averaging is that it helps you buy when the stock is at low points, and that's when it buys more shares. Because our purchase price for XYZ in this example was $9.74, which is less than the purchase price that we had when we used dollar cost averaging. Now, there is a downside though with value averaging. So if you contrast this to the dollar cost averaging example that we had, in dollar cost averaging, we owned 17.6 shares at the end of the example. Whereas here in value averaging, we owned only 13.63 shares. So there is a trade-off there in how much money you can gain in terms of volume. Now obviously though with our example, it was a bit extreme with the stock going all the way from $9 to $20 in such a short time. But just for the purposes of this example, we use those numbers. Okay, so let's recap. There are three main ways that you can enter into an investment. There is lump sum, where you have a set amount of money that you then just buy the stock at whatever stock price it's available at now, or whenever you're doing this. And you just put all your money in at one time. Now the second type then is dollar cost averaging. Dollar cost averaging is great for volatility. You can invest a regular amount, say if you get a regular paycheck, and you want to invest a certain portion of your paycheck. Then you take that portion, divide it by the stock's current price, and just buy that number of shares, and you keep repeating that in regular intervals. So that makes it great for volatility. It doesn't care about what the stock price is doing at the moment. It's just a repeated process. But the downside for it though is that it can increase your purchase price, which can offset some of the gains that you make. And then the third type that we talked about was value averaging. Value averaging, you have a goal that you want to reach during each time interval. During each time period then, you look at the present value of your investment and see how that compares to your goal. There's a difference where the present value of your investment is less than the goal that you have, then you make up the difference by buying the appropriate amount of shares. And this method is really great for lowering your purchase price, but the trade-off then is that you may not make as much money because of volume and the number of shares that you have purchased. I hope you enjoyed that episode and learned something from it. If you're looking for recommendations for good investing and business books, I encourage you to check out the Project Business Basics blog and also sign up for the Project Business Basics newsletter. You can do all this through the Project Business Basics website, which is www.businessbasics.online. Also, make sure to check out our social media. We're on Instagram and Twitter with the username at PROJBIZ Basics. I'm Archie Schnarker. This is Project Business Basics. Thanks for listening.